Welcome to the Kickstart My Franchise podcast. I'm your host, Tim Michaels. Today, I'm excited to be joined by Jason Smith, who is the VP of Business Development for a company called Lendzee.ai. Welcome, Jason.
Hi, Tim. Glad to be here. Thank you very much.
So what exactly is Lendzee.ai?
Great question. Lendzee is an AI-driven funding platform. And I know everyone uses AI right now as a buzzword, but frankly, we've done a good job of actually implementing AI to our platform. And what that means is this. Over the last decade, we've aggregated hundreds of thousands of applications, both approvals and declines, from many different lenders. We have just under 300 lenders in our network. What we've done, though, is taken all that data and started bouncing that data against these lenders to reverse engineer the underwriting process. That's allowed us to have intelligence on these lenders that, frankly, I don't know that they know they have. And so what that means is now we understand simple things like which lenders report to which agencies, what time of the month they report to those agencies, what to put on applications specifically to get past decline filters, what time of day to submit those applications, even behaviors of specific underwriters and account managers at different lenders to help us negotiate rates and terms. So it's allowed us to create an ecosystem where we've now become a plug-and-play funding division for franchisors, franchise development companies, and funding brokers.
That's super interesting. So let's take a hypothetical situation. So I work with a lot of people who are considering buying a franchise. Most of them don't really understand their funding options. I come to Lendzee.ai. What are the different options out there? Just give us sort of a lay of the land.
Yeah, great. So, right now, all of us, as far as funding companies in the franchise space, are offering the same types of loans: SBA, equipment, unsecured, ROBs, lines of credit, even HELOC, right? What makes Lendzee uniquely different is the process and the system. I had touched on this before we got on this. There's a process and a system when you buy a franchise, but when you got to the funding element of it, that seemed to kind of break down a little bit for the client and the end user. And then the proverbial, well, what's going on with my application? Who am I actually talking to? We wanted to create a situation where that was different. So with Lendzee, every one of our partners has a co-branded landing page. When you fill out that landing page, it doesn't cost the client any money. It will not impact their credit. And the system now goes out and aggregates all of their data against the historical data we have with other applicants and then against the lending network. And so we get back real approval. So instead of the traditional, let's shotgun this out to lenders, see what lenders bite, we know specifically what lenders to go to. Once they fill out the application, we created an ecosystem where the client is walked through a process and a system for transparency. So the moment they land on the landing page to fill out the application, there are AI videos there that explain the process to set the expectation of here's what working with Lendzee is going to be like. Here's what different loan options are going to be available. Within 24 to 48 hours, they get a consult call from my team. And on that call, to your point, here's where we discuss all of your options. Let's not talk just about SBA or just about ROBs. Let's talk about all your options, help the client come up with their own funding plan based on their short and long-term goals. Once they've come up with their plan, they then simply, right there online, upload their documents to my team. My team begins underwriting or pre-underwriting the file. We get a pre-approval sent out to them online, which they sign. Once they've signed that agreement, again, another landing page to say, hey, you've completed the first two steps. Now let's get your consultation call scheduled, go through your pre-approval, and let's start working on applications. So on that call, once we've identified, let's say, unsecured term loans, now that client is very clear on what they're doing and the timeline that's going to happen. And it's all online with our reporting dashboard.
Super interesting process. A lot of people that I speak with, they don't really understand what all these terms mean. Can you just, in like simple terms, go over like each of the main funding options that a new franchisee has and just give us like the pros and cons or just an overview of what exactly that entails?
Yeah, I think the most popular one that we often refer to is the SBA or Small Business Administration. That's a loan supported or backed by the government. So the lender has some viability or some assurance that if something were to default, part of that loan would be covered by the Small Business Administration or the government. Now, that's a loan that's very popular. We offer those loans. Those loans can be anywhere from 10 years to 30 years. Some of those loans might require a 10 to 30% upfront down payment, what we call skin in the game. An SBA loan might require post-closing liquidity. And what that means is you might have to have a certain amount of cash in reserve to be able to afford the payments on that SBA loan. An SBA loan oftentimes has a collateral requirement, so that could be, a home or another business. So SBA loans are very popular because they're supported by the government and they're very well known in the franchise space. So that's one option. Then you can get into equipment loans. Equipment loans are exactly how they sound. It's a loan based on the equipment, so it's collateralized against the equipment that you're purchasing. And those rates and terms are all going to vary on the type of equipment, the industry, the client themselves. If there's an existing business or not, then it's going to look at personal or the business revenues and credit capability. Unsecured term loans are by far the most popular thing that we do. Unsecured term loans are how they sound, right? There is no collateral. There is no down payment. There is no post-closing liquidity. And unlike an SBA loan that might take 3 to 6 months on average, an unsecured term loan, if all the documents are in and credit looks good, we've had them closed in as little as 7 to 14 business days.
Wow.
Right? Yeah, and those terms can go up to 12 years. So not the 30-year that you might get with an SBA. So that's something you have to consider. But, a 7 to 12-year unsecured term loan can be a very unique situation for a franchisee. Now, I say that because there are certain franchises that you look into that may take longer with the SBA because it might be an emerging brand that don't have a lot of pens on the map, right? And that's where unsecured term loans can overcome that deficit. Then we have ROBs, rollover for business startups. That's where you're leveraging your retirement funds, right? And now you can create a C corporation, roll those funds from a qualified account, maybe with a previous employer, and let's say there's $150,000. You roll that into a C corp. The C corp now has invested in your business, and now you're operating essentially with your retirement funds. That's a great tax vehicle. There's some great information on our website about the ROBS program.
Quick question on that one. Are there any specific benefits or negatives to forming a C corp from a franchisee's perspective?
Yeah, that's a great question. I don't necessarily see negatives in it. I think the positives are you're able to use that money from your retirement. It's non-taxable when it comes over. So it's a non-taxable event when it comes over. And there are tax strategies that the revenues that you bring in, you can tax defer. So that's a huge plus. If there were a negative, I would say maintenance. Maintenance on a ROBS program with a C corporation, there's compliance according to the IRS that you have to have. And I believe it's a Form 5500. And our partner, Tenet, this is something they do very, very well. In fact, I leverage Tenet when we offer a ROBS program. And so that maintenance, that 5500 every year, the account valuation, those things have to be ready. Also, in operating that, you've got to watch out for things that might be prohibited transactions. And those are really kind of gray area when you look at tax code, which is why we work with Tenet, because Derek and his team really know that product inside and out. That's how they founded Tenet Financial, was through a ROBS program. Now, what might sound unique is here is Lendzee, a funding broker, if you will, or funding company in the franchise space, talking about one of their competitors. And I bring that up on purpose. At Lendzee, we want to partner with companies like Tenet, United Franchise Group, Benetrends, whoever we can partner with to complement each other in what we offer and what we don't offer. We never want to be a competitor. We always want to be a complement, and that's our partner mission.
Awesome. So if I'm a new franchisee or about to become a new franchisee, I would come to you instead of one of these other companies because you're going to help me think through all my options and sort of put me in the best place based upon your historical data. Is that the way to look at it?
Yeah, that's a great way to look at it. So it's what I call the 4 T's. There are the 4 T's in our space. There's the time. So how long does it take to get from application to receiving your funds? The team. Do I have a qualified team that really understand this space? The technology. Is there technology in place that can really help us accelerate that process? I'll give you an example of the technology in its real-world application. We've had clients that have gone to some of our competitors for unsecured term loans and end up working with them for several days and only getting declined.
Mm.
found us through Google. We put them through the Lendzee platform, went back to the same lenders that were giving them declines and got approvals because we understand what to put on applications, when to submit applications, all of that inside data. Imagine having a personal banker that's been working there for 10 years that knows everything about the bank and how to get you the best money, the best rate and term. Lendzee is that person at every bank that we network with because of that reverse engineer process. So
Got
that's
it.
the technology, the team, the time, and then finally transparency. We're very open. We have a reporting dashboard that we've developed that our partners can log into and see exactly where their clients are in the process. Same with the client end. They get to know exactly what's going on. My team is texting them, emailing them, calling them. They can log in and see exactly where they are. So there's never that what's going on with my funding process in this franchise model that I'm in.
Got it. And in terms of like costs to the franchisee, is it like an upfront payment to you guys, or like what does that look like?
Yeah. So there's never any upfront costs with Lendzee. We work strictly on a success base. So we have what's called a success fee at the end. And I say that because we have clients get right down to the day of distribution of funds and then back out and say, hey, we don't want to do that franchise anymore, or I don't want to use that specific type of loan. We're going to put everything on hold. Great. You owe us nothing, right? It's when money has actually been deposited in the business bank account or their personal account, however they're doing that. That's when we send an invoice for our service. So yes, the client is paying us. And the reason we adopted this model is traditional brokers are working for the bank. So if the bank is paying me, the bank has to do something in order for them to protect that investment. Meaning, if the bank says the rate's 12%, right, that could mean there's 2% being held back to pay the broker. With
Mm,
Lendzee, we don't participate that way because that 2% over a 12-year, 15, 30-year loan, the cost of that is something that we have to pay attention to, right? So the client's going to pay us at the end to help reduce all those ongoing fees, those long-term fees.
interesting. Okay. Yeah, no, that's a super helpful insight and something I wasn't aware of. So appreciate you sort of drawing that out.
Yeah.
Um, in terms of other things that we should know about Lendzee.ai, is it a process where I just go on the website and fill out an application and it's sort of easy as that, or like what should people expect as far as the process and timeline?
It really is as simple as that. You go online, you fill out the application. The moment you hit submit, it lands you on a landing page that sets the expectation of the next 6 steps that you're going to go through. Within 24 to 48 business hours, an account manager on my team is going to call the client. Hey, we received that. Let's have a consultation about what you have now, what you're trying to accomplish, what assets you have, what is your liquidity. Let's talk about all of your options, come up with a funding plan. That's all going to happen within 24 to 48 business hours. Usually within 3 business days, we'll have a pre-qualification sent back to them. Now that's assuming that the client's given us all the documents. If we're chasing them to give us verification of income, that might take that a little bit longer. But with unsecured term loans, for instance, last year, Lendzee processed 700 applications for unsecured term loans for $84 million at an average loan amount of $120,000. And it took us, on average, 17 days from start to finish, from application to funding.
Yeah, no, that's fast. In terms of the unsecured term loans, I'm not overly familiar with them, but I'm assuming that the interest rate is higher than the SBA loans. Is it always like a set percentage higher, or like how much more should people expect the unsecured term loans are from what they're going to see at an SBA loan?
Yeah, that's a good one, Tim. With the SBA, you've got prime, which right now I want to believe is 8.25, 8.5, and then
Mhm.
plus 2 to 3 points is typically. So it's kind of a standard set with the SBA, right? In unsecured, it's completely different because it's based on many factors: the client's credit score, their income, their debt to income ratio, the industry that they're in. All of those things play a factor. And so, to your point, these are also non-collateralized. So the interest rates are going to be a little bit higher. SBA right now, we've been seeing anywhere from 12 to 13 to 14%, somewhere in that kind of range. Unsecured term loans have been starting at 8.9%. We've seen them as high as 19%. On average, we're seeing 12 to 15. So they're kind of competitive with the SBA right now. But the SBA is always going to be better from an interest rate perspective than an unsecured term loan. So there's your pros and cons that you have to weigh, which is what my team will do with you. What are your short and long-term goals? Long term, if you're going to be in this business for a while, and maybe SBA is that vehicle. If this is a short term play, something you're going to build and try and spin off, let's leverage an unsecured term loan, get you into it quickly, and not have to have all that collateral.
Mm. And on the subject of collateral, I get this question from people a lot as far as like, well, what happens in a worst case scenario? Like I get into this franchise and it just does not work out. Can you talk about like if you're more protected under certain types of financing versus others and how people should think through that?
Yeah, so from a protection standpoint, this is why I like unsecured term loans more than any other vehicle when you talk about funding. Because if something does go wrong, in the unsecured term loan space, we do have lenders that will look at personal credit, but will report it to their entity with a UCC filing. So it's a commercial startup loan. It's not against them personally, right?
Mm.
At the same time, if we're talking worst case scenarios with unsecured term loans, I can restructure that debt fairly simply, or I can bankrupt that debt and start over. With SBA loans, that becomes a little bit more problematic, right? With the collateral of the house, it's not like they're coming to take their house. And I don't like it when people fear monger that way. That's not the role of the SBA, but it's something that says, if you have the collateral of your home against an SBA loan and something goes wrong, they're obviously going to try and work with you to restructure that loan to help you. But they're using the asset that if you were to sell that home, they do have the right to go in and ask for equity net play. If you bankrupt, again, now you have the house as collateral. So if there's any equity there, the SBA or that lender can come after some of that equity. So,
Mm.
those are worst case scenarios. What we try to do is in our consultation is address all of those things and try and understand what their mindset is. Again, short and long-term goals, because if something does happen, worst case scenario, let's always be prepared for that. A good business owner always has a contingency and an exit plan. Sometimes that exit plan is the positive. We've sold the business. Sometimes that contingency and exit plan should be what happens if things go south? What happens if we have another COVID? Are you prepared for that? Have you structured your financing in a way that's going to accommodate those kind of ebb and flows?
Absolutely. In terms of the different options, I don't think we've touched on HELOCs too much. Can you go into sort of the pros and cons of a HELOC and what exactly that is?
Yeah, so pros and cons of HELOC. The pro is you're taking money out of the home that you don't have necessary reporting against your credit, so to speak, and it's not affecting your debt to income ratio, and it's easy to get. So that's the pro, right? The downside is you're tapping into the home's equity, so you're leveraging some of your own equity, which, look, if we're smart, we're thinking from a retirement standpoint, we have our traditional retirement plans, but our assets, our homes can sometimes be part of that. So we have to really ask ourselves, do we want to leverage the equity in the home? Sometimes it's better to leverage the equity in the home depending on your financial situation. Maybe you don't have necessarily the income to support certain activity on traditional term loans that have higher interest rates, right? Whereas historically, your HELOC would have a lower interest rate and a 10 to 30-year repayment period. Right now in the HELOC space, we're seeing 5 to 6% on average. One thing
Okay,
that, yeah,
that's a lot better.
yeah, right. So then you have to look at that. Sure, I'm paying less. I'm paying 5 to 6% on a 10 to 30-year note versus maybe an SBA or unsecured, but I've also given up the equity. It's an equity
Mhm.
play, right? And what happens if the business goes south? I no longer have that equity in my house, right?
Mhm.
So those are things to consider. One thing we've aligned ourselves with is some HELOC lenders that will do 90% loan to value or up to 90% loan to value. We can close those in 5 to 7 business days. That includes a 3-day right of rescission. Doesn't require an appraisal. And again, interest rates are right around that 5 to 6%. So you look at those type of lending situations, and why wouldn't someone just go to their own bank? We encourage, go ask your bank first, right? Instead of paying us a fee, if you can get it from your bank, go do that. What we have found, though, is most traditional banks in the HELOC space have stopped lending as aggressively as they used to. So we're seeing 75, 80% LTV, right? We're seeing 6, 7, 8% in interest rates. We're seeing 10-year terms versus 10 or 30. And so that's sometimes we'll have clients come back and say, I checked with my local bank. They're willing to give me some, but if you guys can get me more, we'll go through you guys. So I don't know if that answered that question the way you wanted to, but that's the HELOC service.
Yeah, no, super helpful. One other question I wanted to touch on is sort of how does the size of the investment sort of impact what makes the most sense as far as your funding options? Specifically, like if let's say it's a 100,000 or less total investment. Does that change at all as far as like what options you can use and what is sort of like the thresholds?
Yeah, so changes the options you can use, definitely. And I'll answer it this way. Typically, with our firm, what we do is anything that's over 500,000, really not going to be a good unsecured term loan space. We kind of max out at that 500,000, and that's a really strong credit profile, and it might be husband and wife, total household income to get up to that 500,000. Really, if you're in that 100 to 150,000 to $300,000 space, you can look at SBA, you can look at unsecured term loans, you can look at HELOC, you can look at ROBs, and all of those. And we encourage all of our clients to do that, compare and contrast. So the threshold really, there isn't necessarily a quote unquote threshold. It's about your comfortability and what you're trying to accomplish with it, right? So if you look at that 150 to $300,000 market, and we look at HELOC versus SBA versus unsecured, you can start already just from our conversation comparing the three of those and how I would maybe choose one of those based on my goals of short and long term play here with this new business. That
Mm.
being said, anything over 500,000, typically we're looking at an SBA loan because they'll loan up to 5 million, right? These SBA lenders because it's backed by the government. Whereas unsecured term lenders are not going to loan that much.
Let's say I have, 30,000 in cash to my name, and the total investment is 70,000. Is there any way for me to bridge the gap? Like I've heard sometimes like SBA loans, it has to be above a certain amount. How should I think about that?
Yeah, so with the SBA, that is true. Usually anything under 150,000, not going to be a good SBA play. Those, the time and effort that it takes, and then giving up collateral and post-closing liquidity, it doesn't make sense, really. So in that scenario, hey, you've got 30,000, you're needing 70,000. I would use an unsecured term loan to bridge that gap.
Mm.
In unsecured term loans, if you've got a credit score of 680 and above, you can verify, income, either W-2 or tax returns. Again, that's all you really need. And then you let a system like Lendzee go in and bounce all that against the network to find the right lender. But they're very easy to get into. You can close quickly on them. So in that scenario, for sure, I would use an unsecured term loan. Or if you've got 30,000 cash, if you own a home, if there's equity there, there's a play. If you don't own a home, unsecured term loan. If you've got $30,000 cash and you've got a retirement plan from an old employer just kind of sitting there not doing much, do a rollover and start leveraging that, and maybe do a combination of your cash, unsecured term loan, and retirement. So yeah,
That
those
was
are the
going to be
kind
my
of
next question. So
yeah.
you can use multiple different options. Like for instance, I have a lot of people where it's like I have 100,000 or 150,000 in a 401k, but the
Mhm.
total investment is 300,000. Can I use that 401k for a portion and then get an SBA or something for the remainder?
Yep. So that's a lot of people will do, retirement and SBA or retirement and unsecured. I've even had a client do retirement, unsecured, and HELOC. One thing you're not going to do though is you can't do retirement, SBA, and then unsecured, right? Because the SBA is going to look at that new loan that's going to count against your debt to income ratios, right? So that's going
Ah,
to
okay.
go against the SBA. So there's a strategic way. So can you use multiple options? Yes. But again, it comes back to client education, which we do in the very beginning. Understand those options. So you can leverage multiple options in one funding plan, but there has to be a strategic way that you do that.
That's very interesting. Is there any, just last comments you have either about Lendzee.ai or other things you want people to know?
I think last things I would say is not necessarily about Lendzee, just in general. I think the funding piece in the franchise space can be daunting, can be scary, especially for those that don't have the experience. You take Joe the plumber who wants to retire from plumbing, has no idea what he wants to do next. The franchise space is great. Look, here's a built-in system that's working. You're going to plug yourself into that, and then you get to the funding aspect. Well, maybe he hasn't done well over the years of saving, money, but he's got good credit. And so then the confusion happens. And that's where, again, I mentioned the breakdown in that system and process of franchising in the funding. That's where it breaks down. Don't be afraid of it. Embrace it. Talk to many different people. Talk to people that have been in the industry. When you talk to franchisees, other franchisees of a franchise you might be looking to buy, ask that funding question, not just how was the process? How did the company help you develop? What was the marketing like? Ask those questions. How did you get started? How did you leverage? Did you leverage retirement? Did you get an SBA loan? Ask those questions and don't be afraid of it. Get educated before you make a decision. And certainly, of course, if Lendzee can help with that, we'd love the opportunity.
Awesome. Really appreciate your time here, Jason. I learned a lot, and I hope all the listeners did as well. Looking forward to working with you here in the future.
Thanks, Tim. I really do appreciate it. Have a wonderful rest of the week.